I was surprised to see that the rate of growth in M2 has dropped from 27% in February to 13.8%. And it's a pretty sharp fall. So the rate of money growth is decelerating quite rapidly. I do believe that what's going on in the bond market, this big surprise, it's really the flip side of the surprise that I witnessed when I first started in the business in the late 70s. I remember I used to deliver, and everything was by hand. There were no computers. In the late 70s, I used to deliver the inflation reading it was the first or second Friday of every month. And my boss at the time just didn't believe the inflation numbers, but the bond market was getting it right. He just didn't believe that the numbers were right and thought they would correct and that the interest rates would come back down. I think we might be on the flip of that right now. The bond market is signaling there are more deflationary pressures brewing out there, we believe, than most investors appreciate. I've just mentioned the good deflation associated with innovation, but the other side of that is creative destruction and the deflation that will hit companies who have leveraged up to buy back shares, manufacture earnings growth, have not invested enough in getting ready for the new world. And believe me, every sector is going to be transformed. And so they will face significant pricing pressure as their products really go obsolete eventually. And then the cyclical deflation. Well, the bond market seems to say this is what's happening. And if that is true, because most people don't believe 1.5% is a real interest rate, they've been normalizing, I think, in terms of the way multiples have worked out in the market, the equity market. They've been pricing or valuing stocks as though the normalized interest rate is somewhere around 4%. What if it's not? What if it is half of that? That would be huge for secular growth companies. On monetary policy, well, we had the FOMC meeting this month, and the tone coming out of it, the markets at least thought, was hawkish, meaning the proclivity to tighten monetary policy was increasing. And given the economy that we have, actually, that should be the case. We are in quantitative easing mode, and the economy is flying. And we're in the sharpest rebound from any recession, according to the National Bureau of Economic Research, the sharpest rebound from the shortest recession and the sharpest recession in post-World War II history. So it would make sense. We're out of the woods for monetary policy to normalize. And in a stealth-like way, it might be doing just that. I was surprised to see that the rate of growth in M2 has dropped from 27% in February to 13.8%. And it's a pretty sharp fall. So the rate of money growth is decelerating quite rapidly. And for those who are monetarists, I am not, but for those who are monetarists, that's going to be a source of relief from an inflation point of view. Now, it is still higher than the 6 to 7% growth rates in place before the coronavirus, so twice as high, as a matter of fact. But we're looking for clues as to why the bond market, against all odds, continues to rally. And that's both the Treasury and the corporate. And the reflection of that is corporate yields are very low relative to Treasury yields if we look at them in the context of history. And as you know, we have a bias based on our research on innovation to focus on deflation, because technologically enabled innovation is inherently deflationary. So we have that bias. But I will tell you, with the CPI reports that we have gotten, PPI as well, much higher than expected, I would have expected the bond market to continue to sell off and interest rates, therefore, to go up. Instead, since the end of March, the 10-year Treasury bond yield has dropped from 1.74 to 1.43, no matter how strong the economic data have been, how high the inflation numbers have been. And so the bond market is sniffing something out, I believe. Now, many will say, well, it's just quantitative easing. And I think quantitative easing was true at the beginning of this year and through March, when we went from 0.9 to 1.74. So nothing's changed on that score. But the bond market is sniffing out something here. Is it the deflation associated with innovation? Well, as much as we would like to think, all of the innovation platforms around which we have focused our research, so DNA sequencing, robotics, energy storage, artificial intelligence, blockchain technology, the base at which they're operating in absolute dollar terms is quite low to the rest of the economy. Nonetheless, from a competitive point of view, innovation is going to cause some legacy companies to cut prices in order to stay relevant. So it could be. And I'd like to think that is the case. That's a very good source of deflation. What it means is, as prices come down, demand picks up as more and more sectors participate in the new technologies. The bond market could be rallying because of what I just mentioned about money growth. I don't think many economists have observed, I haven't seen it at least, that the money growth rate has been cut in half from that 27% to 13.8%. Maybe the bond market is focused on that. Just to talk about a few other disconnects here. Against, I think, the consensus expectation, the consensus short on in terms of currencies was on the dollar at the beginning of this year, and the dollar is not going down, and that's also consistent with the bond yields coming down, surprisingly. Now, it is true that our bonds are offering, even at this low rate, 1.4%, 1.43%. They're offering more than the negative yields elsewhere in the world, Germany and Japan. But that's been true. That's been true for a very long time. So at the margin, that we do not believe has made the difference. What could be making the difference in terms of the dollar going up is this notion that the terms of trade are not going to turn as much against the United States in the form of higher corporate tax rates. And in fact, this 15% minimum tax will hit everyone in the world. Now, it will hit disproportionately some of the very profitable tech companies who have been able to manage taxes globally to very low levels. But that, again, it's true for everyone. So at the margin, maybe that is why the dollar's going up.